Everyone thinks they know how the modern financial world works. People trust that the biggest institutions are too diversified to fail, too risk managed to collapse, too essential to ever be shaken. And for decades, one institution has stood above the rest as a symbol of stability: Vanguard, the quiet giant, the index fund empire. The company people believed could never lose big, never miscalculate, never break the system. But today, something has happened that no one expected. Because for the first time in decades, Vanguard for World, a second largest asset manager, the backbone of millions of retirements, pensions, and global portfolios, is facing losses so large, so sudden, and so destabilizing that even the most experienced analysts are whispering a terrifying phrase: "This wasn't supposed to be possible." And the mystery is simple, yet unsettling. How does the safest investment company on earth wake up to billions in red? And why, behind closed doors, are major banks, regulators, and hedge funds treating this moment like the early stages of another systemic crisis? To understand how we got here, we need to stop pretending the modern financial system is built on stability. The truth is that Vanguard, like every giant institution, is not a rock, it's a pressure system, one built over decades, shaped by economic storms, political decisions, and financial engineering so complex that even insiders sometimes lose track of how the machine works. Vanguard was founded on a simple idea: keep costs low, keep risk low, and let the market work for everyone. John Bogle, its legendary founder, wanted to create an investment revolution that gave ordinary people access to the same tools as the wealthy. Index funds became the quiet superpower of global markets, growing larger and faster than any analyst predicted. But with size comes gravity, and with gravity comes vulnerability. Over time, Vanguard's structure built on scale, passive flows, and massive liquidity demands created a hidden fragility. What happens when the money flowing in reverses direction? For decades, passive investing was treated like a miracle. People believed it would always deliver steady returns because it simply followed the market. But the more money that poured into passive funds, the more those funds became the market. This is where the story truly begins. Because what seems like a harmless detail becomes the first domino in a chain of events that eventually leads to Vanguard's losses and Wall Street's panic. Imagine a system where trillions of dollars move in the same direction at the same time, buying the same stocks, holding the same bonds, following the same algorithmic rules. That is the world Vanguard helped create. A world where any shock, any interest rate shift, any liquidity crunch can ripple through passive funds like a wave. And over the past 2 years, the shocks have been relentless. The origins of Vanguard's current losses go back to the last interest rate cycle. When rates were near zero, institutions across America bought long-duration bonds to lock in yield. Vanguard included, and the value of long-duration bonds collapsed. Suddenly, the safest investments in the world became the most dangerous. Vanguard, which had billions tied up in government and corporate bonds through its flagship funds, started absorbing the impact. The losses didn't happen overnight. They accumulated quietly, month after month, hiding behind weekly market rallies and optimistic headlines. But while the public ignored the storm, Wall Street insiders started noticing something alarming. Vanguard's bond funds were posting some of the worst drawdowns in their history. And because of the sheer size of Vanguard's holdings, these aren't just numbers in a spreadsheet. They are shockwaves moving through pensions, retirement accounts, sovereign funds, endowments, and global markets. But the real breaking point didn't come from the losses themselves. Losses happen, markets fluctuate. The real danger came from something far more frightening: outflows. When they do it at scale, passive funds are forced to sell assets, often at the worst possible time. This is where the crisis truly ignites. Vanguard is not designed to deal with massive outflows across multiple asset classes at once. Passive funds depend on predictable behavior. They depend on investors staying put. This mass movement didn't begin with Vanguard, but Vanguard is the one paying the highest price. Over the past year, investors have faced high inflation, rising living costs. Money that once flowed calmly into index funds has started flowing out. And here is the terrifying part: these outflows force Vanguard to sell into a falling market, which drives prices even lower, which triggers more outflows, which forces more selling. A self-reinforcing loop. A liquidity spiral. and the UK pension crisis of 2022. The breaking point hit when Vanguard S-bond funds experienced what analysts are calling a stress event, a moment when outflows exceeded the fund's ability to manage them smoothly. Normally, bond markets are liquid, but the modern bond market is not the market of 20 years ago. Liquidity has evaporated. Dealers hold far fewer bonds. Trading volumes collapse during panics, and when a giant like Vanguard tries to sell billions in fixed income during a thin market, prices crash instantly. This is exactly what happened. A single fund S attempt to manage redemptions created a price drop that triggered redemptions across multiple other funds. The contagion had begun. Wall Street understood the implications immediately. When the second largest asset manager in the world struggles to manage outflows, it is not just a company problem, it is a system problem. Banks began quietly reducing exposure to assets heavily held by Vanguard. Hedge funds started shorting ETFs connected to bond markets. Market makers widened the spreads. Liquidity providers demanded more collateral. And behind the scenes, major institutions started moving capital into ultra-short treasury funds, preparing for the worst. Panic had not gone public yet, but behind closed doors, financial institutions were acting like something catastrophic was underway. Vanguard, for its part, tried to calm investors. They issued statements. They emphasized long-term investing. They insisted the losses were manageable, and on a superficial level, all of that was true. The panic comes from what this moment reveals. The passive system is not immune. The strategy that dominated global finance for decades finally showed its weakness. Even sovereign funds that rely heavily on index strategies, in the 1980s savings and loan crisis, institutions ignored interest rate risk until it destroyed them. In 2020, markets ignored structural fragility until a single shock triggered the fastest crash in history. And now, once again, the system ignored duration risk, liquidity risk, and concentration risk 3 problems baked into the passive investing model. When markets rise, risks hide. When markets fall, risks explode. As Vanguard began processing the fallout, the next phase of the crisis emerged: the failed fixes. Wall Street tried to stabilize liquidity through cross-market arbitrage, but thin markets made it impossible. Brokers attempted to offset losses with derivatives, but volatility pricing made hedging too expensive. Regulators floated the idea of relaxing capital requirements temporarily, but the proposals stalled in political gridlock, and analysts suggested temporary halts on bond ETFs, but doing so would trigger even greater panic. Every fix created new complications, and every complication fed the narrative that the system was not prepared for a passive fund liquidity shock. Modern parallels make this even clearer. When the UK pension funds collapsed in 2022 because of interest rate shifts, they were using leveraged strategies tied to long-term bonds. When Silicon Valley Bank collapsed in 2023, it was because of unrealized losses on long-duration bonds. When Credit Suisse fell, it was because years of risk buildup finally met a liquidity shock. Every one of these episodes was a warning, and yet the global markets continued building more and more exposure to long-duration assets, assuming long-term always wins. Vanguard's current losses are simply the largest expression of this pattern. Vanguard's losses matter not because they threaten Vanguard itself, but because they reveal how exposed the entire financial system is. If the most conservative, diversified, passive institution can suffer this magnitude of loss, how vulnerable are the smaller players? How vulnerable are regional banks, pension funds, insurance companies, and corporations relying on bond markets for stability? And how vulnerable are ordinary investors who believe their portfolios are on autopilot? In the end, the Vanguard crisis is not about one company. It's about a system built on the illusion of safety, a system where trillions move together, and a system that, once again, has been caught off guard by the same forces that have shaped every major financial collapse in history. The takeaway is simple but sobering. Scale does not eliminate vulnerability, it multiplies it. And third, diversification only works when liquidity exists. The warning is even more unsettling. Vanguard's losses may be the first major sign of something much bigger: a slow burn credit crisis, a bond market unwinding from banks to corporations, and from corporations to everyday people. It may not happen tomorrow, or next month, or even next year, but the structure of the system makes the outcome inevitable. Hachisami point. A liquidity event will trigger a broader cascade. And so the final thought is this: crises don't start with chaos. They start with small cracks that everyone thinks they can ignore. Vanguard's losses are not the end of the financial world, but they might be the beginning of a new chapter, one where investors must rethink what safety really means, what stability really looks like, and what risks truly matter. If you found this breakdown valuable, subscribe for more deep dive financial investigations, because the story unfolding right now is bigger than Vanguard, bigger than any single institution. And without understanding it, you will miss the most important shifts happening in global markets today.